Hello guys, once again I welcome you back. So today I'm going to share something, and we are going to look at how to master institutional supply and demand. And today we are going to be looking at an in-depth guide about this. So in this, I believe I want to answer at least these four questions that we are seeing over here. What is supply and demand? What is institutional order flow? And how to find a high probability zone? How to enter and exit the market? So these have been the guiding questions behind today's episode. So someone asked, "What is supply and demand?" As far on the last video, it was a comment in the last video, so that's why I'm here to address that. So now I want to start here. Uh, in the market, in the market, in the market. If at all, let me start with a case of, let's say, bearish case. You get, if at all the market moves normally, we know. I always say the market moves in that kind of way. You get, and now let's say it retraces. We are in retracing. So now, if at all we are moving, let's say at this price point, at any price point, be it here, be it here, you get. Let me actually use these two price points. You get, for some, for the market, for someone to, let's say, sell at this point, there should be someone buying. You get, so it means there is someone buying at this price point, and now there should be someone willing to buy for you to sell. You get, now even if you just place an entry here, you get, for instance, along the way, if I told you place an entry here, you get, whether buying or selling, if I told you're buying here, someone is already selling. If I told you're selling, someone on the other side is buying. You get, so that's why it gets tricky in the market, and sometimes people think it's a scam, and which is not true. You get, so you need to understand something, because I told you, uh like supply and demand, like, for actually this guy, that's it. Like, let me not overcomplicate it. Actually, what I was going to say would complicate things. You get, and now the same case will happen in, if at all we are buying, let's say, if at all we are buying, let's say, to that price point. You get, if at all we are buying to to that price point, if at all we are leaving this zone over here, you get, before we buy at this zone here, if at all we are buying, there should be someone selling. You get, it's just like in the real market. If at all you go to buy grocery, let's say you're going to buy tomatoes, so you're going to go to the market, someone is selling, and then for you buy. And now it complicates things further. You get, more so when we come in the financial markets. You get, now, when it comes to that, you get, when it comes to that, that's why we start. I want us to develop some kind of a mechanical strategy. You get, like something, because I want us to, for anything. By the way, I just realized, like, recently, if you want to know more about the future, you study more about the past. You get, so we are going to be studying the past, what has happened in the past, to see maybe what will happen in the future, like how to properly determine market direction. So now, if at all, let me give that example here. You get, this is a bearish market because we have a bearish breakout structure here. You get, we come and break structure there, and now let me also okay, this is the selling side. You get, so now in the market, you get, we are studying institutional supply and demand. So in the market, you get, we believe, if at all, if at all we reach in this zone, you get, in this zone, and the market gets a reversal, and then we turn. You get, and then we turn, and then we drop. You get, the market drops. You get, the market drops. We believe this was a valid area of supply. You get, we believe it was a valid area of supply. So now, for the market to move from this point down here to this point up here, and then dropping, you get, they are what we call movers of the market. These are institutions. You get, this is a very, very, very huge market. It requires a lot of money for it to move from this point to this point, and then moving down. You get, so it brings in. So I'm answering the part of what is supply and demand, and now we are bringing in the part of institutional order flow. So institutional order flow is going to be, how do these institutions fill in what we call orders. You get? How do they fill in orders? You get? So now for them, they use like these two ways. You get? One of them is what we call, they can choose to be passive. You get? Or there is what we call types of traders. You get? There are what we call passive traders, and then we have what we call aggressive traders. Now those are the two types. Now I'm going to start with the passive traders. You get? But in this case, we are looking at the institutional side. You get? We are not mainly focusing on ourselves, because these are the big boys, these are the ones who are moving the market. So now, passive or trading passively is where you're going to use limit orders. You get? So now you use a limit order, for instance, here. You get? You place, if at all we are in a bearish market, you activate your orders are activated using sell limits. You get? So which means the market moves, or the market moved from this point and then it came down. You get? Now when it comes down like there, you get, for the person places an order here, because maybe there could be a fair value gap, or there could be an order block. So now I'll be talking about more in of those in the next episodes, fair value gaps and order blocks. So please stick around. So now let's say someone, their character, this is a point of interest, and it should have certain features, or it should have certain things like that really show it to be, let's say, a point of interest. Now when the market moves to this point, you get, now it reverses, and now which means when you tap here, their sell orders get tagged in, like they get activated, even if the market is to move a little bit further. So which means here they will be running at a loss. But these are institutions anyway. They've gotten it, their orders are activated. And now that's why, by the, it's one of the reasons as to why when their orders get filled, because these are huge orders, you get, the market quickly leaves this area and then drops. You get? It's one of the reasons as to why sometimes pullbacks move slow, or if at all you get into sessions during the agent session, the market moves a little bit slow and then drops. But I don't want to focus on that. I'm not talking about market sessions. Now this is a passive trader. But understand this. I want to understand this. I want us to understand this, because by the if I talk about this, it covers the two parts. We are either retracing, or like we are in a retracement or an impulse. Retracement or an impulse. Even in a ranging market, the market is either retracing or an impulse, like that kind of way. And the markets are fractal by the way. Now, w- which means if at all you have a resting order there, you get a sell order there, you get, it will not get filled unless someone moves it, like moves the market to that point. So the market makers, they will move the market, they will buy in order to sell. You get? They buy in order to sell. You get? And now the funny thing is that, you get, the funny thing is that they do not only place here. You get? They might be buying here, but already when they have sell limit orders here, you get, these are all sell orders, but they keep moving because they have more money. You get? They run at a loss. You get? Because in any case, they're the ones moving from this point to this point, and they're the ones who are going to move it to down here. But they know there are other participants, you get, amateurs or us, like the retailers, you get. That's why I can't lie to you. Sometimes it may be a bad day, but I know good days will come for you and me. You get? So now, here as they move, they're getting tagged in, and now the market drops like that. You get? So we've seen the part of aggressive, and now the passive side. You get? And now even us, we could be one of the two. We could either fill in our orders aggressively or passively. You get? But even if at all for them they are passive at this point, they've put a lesser sell limits here. For us, we can get in at these price points aggressively. You get? So it means for us, retailers will have an option. We can either be aggressive or passive at either points. You get? At either points. You get? So now that's the case for a bearish scenario. So now I want us to go on the bullish side. You get? I want us to go on the bullish side. So now we are I want us to understand institutional supply and demand, and don't forget, now we are looking at institutional order flow. Now let's go on what we call the bullish market structure. Let's say, you get, this is a mechanical approach. You get? Now we have a break of structure over there. You get? So we have our break of structure there. Now we are bullish, you get? And mostly we are interested in this impulse run. And I told you here they are passive at this point. They could be passive at that point, you get? Which means they moved and they broken structure. Now they come and place what we call sell buy limits. You get here for the case of bullish, they place buy limit orders here. They could even be many. You get? They could be many buying orders. All these ones that I'm drawing are buying orders, and the institutions are the ones who are selling. You get? Here they come and let's say sell at this point. You get? They come and sell. You get? But they are selling knowing that they have buying orders here. You get? So now here when reach here they buy aggressively. You get? They buy aggressively. So they've been tagged in and now they buy and break structure. So the process, all the cycle continues to repeat. You get? To continue like that. So now we are starting to understand what we call institutional order flow. You get? But now remember, one of the most things that we're interested in, how do we identify a high probability zone for us either to sell or to buy? You get? Because we've seen all that. So now how do we validate those zones? And now that takes us, like when you go on the canvas, on the trading canvas or on the trading chart, like what should you really focus on? You get? What should really focus on? And that's the main interest that we are making this. You get? So now there is what we call now we are looking at the types of supply and demand. And now when we call at the types of supply and demand, it's seeking to address how to find a high probability zone. You get? So in simple terms, I'm saying there are different types of high probability zone. A zone will either be it will either be a supply zone or a demand zone. You get? It will either be a supply or demand zone. So now in this video, I may only talk about two types, and these are the most common. You get? One is what we call range created supply or demand, and then what we call pivot created supply or demand. And now for this, I may mostly focus on what we call range created supply or demand. So I'll talk about also flip zones, but then I'll also make a separate episode for that. You get? So that's why I request you guys to stick around and subscribe. So now we've seen all that. Now we go on the range created. And remember, by the way, when I talk of supply, it's where the market will be. This is, let's say, this is our demand. You get? Demand down, supply up. You get? Don't forget that. Supply here, demand here. So now, uh, what is a range? You get? A trading range is where we see the market, let's say, it moves up, it reaches an area of supply, and then it drops. If at all reach supply, the market will drop. And then let's say we've left this area, which was an area of demand. So now let's say it gets respected. Now we move back like that. Or it may not be perfect on the straight line, but then we can find that there are specific, let's say, zones or candles. So, anyways, we are seeing this kind of movement. You get? In that kind of movement and market behavior. You get? So now, for this, what does it lead us to? So it leads us to, let's say, marking out a zone of supply and then marking out a zone of demand. You get? But overall, this zone becomes our trading zone. You get? You get? We are seeing, or when you go on the chart and you find that you can mark it up. You get? You can mark up that zone. You get? So we are going to be having a full zone now, like here. We are aggregating it or we are totaling it. You get? The supply and demand. So now, in most cases, what does it lead us into? You get? Now when we come into the concept of supply and demand, even if you're a trader, if actually you're traders, you get? If you're a trader, you get? And then you want to buy. You get? If you want to buy, you're going to go in areas of you're going to go in areas of low prices, and then you take profit at areas of or you sell. Actually, you go in areas of low prices and then you go to the market and then you sell at high prices. You get? Or in this case, you're going to be leaving Like institutions will be leaving premium zones, you get, they will be leaving premium zones, you get, to come and buy, to come and buy at discount zones. And then remember, they have the power to move the market. And now when they move the market into premium, now when the market, when they move the market into premium, here they take what we call profit, you get. So that comes if you divided the market into two, you get, into 50-50. The down part being discount, and then the upper part being premium, you get. And now the same case, if at all you want to sell, if you want to sell, you leave areas of low prices, you come and you place your sell order here, you get, they'll come and place their sell order there. And now the market will drop, and then they take profit at low price. Like here, they've made a profit. So basically we are saying how the market is really like moving. And now, why do I start drawing, like leaving, let's say, areas of discount and then going to areas of premium? Because most times, by the way, most people who are illustrating, they will just start here, you get, in premium. Let's say you leave an area of premium, you sell at premium, and then, but remember, the market is not having, like, is joined, you get, it's moving like this, it's joined like that, you get. So that's why I tell you that if at all they wanted to buy, they came and sold, and then they bought like that, you get. That's why I illustrate it like that. So now we've seen premium and discount, you get. So now we've seen our range here. So how do we get a range? Now we are going into, we've created, this is a high probability zone, you get, we having our high probability zone. So now high probability zone, it will either be a high probability zone to buy or to sell. So let's first look at the case for selling, you get, a case for selling. Or how do we get range created supply, you get, range created supply. This is like a subtopic to high probability zone, you get, finding a probability zone. So a range created supply, remember, you get, remember, the market, you get, for, I told you, for the market, like for there to be, for someone to buy, you get, for someone to buy, there should be someone willing to sell. And for someone to sell, there should be someone willing to buy, you get. And now when we look at these zones here, you get, when we look at this zone here, like that one here, let me delete one here. So our supply zone up here. So now people are selling here. There are many sell orders here. You get? We are looking at retailers. You get? For us, we are selling. There are many of us who are selling in this zone because whenever the market is reaching here, they are selling. So there are people who are selling here. And now, where are their stop losses? Their stop losses are just up here. So we are looking at how the market is making profit, how the market makes profit. You get? So overall, yes, we are seeing that there are people who are selling in this zone. So now what will the market maker do? You get? And now what they will do, if at all they want to sell, you get, one of the things they can do is, yes, they will come and move the market. Let's say it has been here. They will come and buy. Remember, they want to sell. You get? Remember, they want to sell. They will leave discount. They come into premium. You get? They place their sell. They come and sell just above here in most cases. You get? So which means if at all they move here, people have been tagged in here. People are already selling here. And where is your stop loss? Just here. It gets hit and now they move because they have more volume. You get? Now, people who were selling here have been what we call liquidated. So the market moves. You get? That is sometimes the initial reaction. You get? They may activate orders in that way. You get? And now they sell, they come and break structure. Now that is one of the ways. Or there is another way. Because there are people who are selling here, you get, people who are selling here. The market could move up to that point. These are the common market maker moves that you will see. They'll move, they will not reach that point properly to fill in those orders. They will come and break here. So we have a break of market structure over there. So now this is what we see. So now when we get a break of market structure here, people are there are a lot of orders here. They are buy orders and sell orders here. You get? Some people are buying at this price point to come and target here, but now they come and liquidate them, and now we're having their stop losses there. You get? And now there are those breakout traders. They come and break structure, and now the market is proceeding. So now they jump onto the trend, they come and sell because we've broken structure there. Now, what will the market do? Remember, we have our retracement. Now, this is what they normally call retest. I'm not a breakout and retest trader, but like all these things work. It depends on the context. By the way, that's why I believe you'll keep on understanding more and more. But it will be better when we go on the charts. I want us to first develop this mechanical strategy. So now they come, they activate their orders. By the way, for them, they may sell at this price point. You get? At this price point, let's say this is institutional sell orders. You get? They activate them, then they come and move backwards. You get? Remember now they can move, they can be selling here. You get? They sell up to that point. You get? They sell up to that point. Let's say there are many orders. They don't just place them in one area. By the way, this is a theory. I'm not an institution. You get? So now, when we reach there, which means they are buying here. But remember, they've placed sell orders here. Now they will drop more. You get? Now that is institutional supply. You get? Institutional range created supply. You get? So now we've seen that. Now we are going to go to range created demand. You get? How do the institutions buy out of a range? You get? If at all we've created a range. You get? So now I believe now you're properly following, and I believe right now you're starting to understand. Remember, now they want to buy. One of the first things they may do is that they're having a lot. Uh, there are a lot of buying orders here because this zone has been created. Well and good. And now, where are the stop losses? Stop losses are just down there, or they may not even be very far. But remember, now what does the institution do? They may move, and now they come here because people are buying here. You get? They buy. So which means if at all they are buying, institutions will come and sell. Because for the orders to get activated, for you to buy, they provide what we call liquidity. Okay, for your buying, they sell. You get? They are selling to you. They sell to you. You buy the asset. You you are not even able to hold it properly because your stop loss is very, very near. They come hit it, and now they move. When they move, we get a break of structure. You get? And by the way, this normally happens. Now, when you get a break of structure there, it's by the way, we really like a break of structure because it takes a ton of money to break a structure. You get? To break a structure. So now we've broken, and now they are making they are buying. You get? So which means for institutions, you get, for institutions to buy, you get, they sell. You get? So along the way of selling here, they could be filling in orders. You get? They can be filling in orders, sell orders as they move. You get? As they move, they can be filling in sell orders. So now they come and tap here, and then they move their orders. They are activated, and now they come and buy. You get? And now when we get a break of structure, you get, when we get a break of structure, most times the market retraces. You get? Retraces. Remember, they are buying. You get? And now we move back. There could be two reasons as to why this happens. You get? One, there could be some buying orders here they've left behind, so they come to pick them on. Or the second reason could be, if at all there is selling pressure, or another institution that is aggressively selling, these institutions will be so keen on defending their orders here. You get? They will defend their positions because if at all they bought, that's why if you properly analyzed a buying order, by the footmarks are like, there are marks that are left behind. If you properly determine that for sure they are buying, even if they try to manipulate the market, or the market moves up and down like that, leaving rejections, trust me, if you've properly determined, you will eventually buy. You get? They try to protect their orders. You get? So now we've seen what we call range created supply. And now maybe if I can talk about a pivot created supply, let me just proceed with this one. Let's say this one is a bearish market, you get. So now if at all pivot created, this is the supply area, you get. So we believe even if the market retraces back, you get, if it retraces back, this is a valid supply zone. We will expect the market to reach and then drops again, you get. That's what we expect. But how do we get a pivot created supply or demand? So if at all the market moves and then it again breaks a structure there, you get. So it's like we've created a pivot, and in most cases, we can see that the market retraces into normally the same zone or another block, and then it proceeds again. You get. So overall, we are not out of a range like here, but then we are out of a pivot. And now we shall see that on the road chart, like sometimes we could have like you find that it's more or less a pivot or a range, you get. So for the case of bearish, so bullish, so let's say we are moving upwards, and now when we move, let's say we move down here like this, we'll expect this area to hold, but then to hold and then proceed. That's what we expect. If at all it comes, let's say we come and break it, and now normally we see that it drops. So in most cases this one becomes this one here becomes our our pivot, you get. It becomes our pivot. So now let me go on the charts, and then we look at this. Remember, you guys, I'm going to bring on this in various episodes. Like we shall be talking about supply and demand, and the more I talk about it, the more I bring it in different case scenarios, I believe it's the more you'll keep understanding it. So now I over here, let me, yeah, this is a pivot created supply and demand. um so let me start with this pivot created supply, you get. Let's start with this one. So now we have, let's say we have our breakout structure there, you get. We have, because the market is moving downwards, you get, we having this kind of market movement, you get. This is how we develop a mechanical strategy. Overall, we have like an exoskeleton of the market movement. So now we can see that we got a break of structure here overall, but we've seen many of them like this one, you get. We've been breaking structures as we drop down. Now as we break these structures, we can see that this is an area of supply, you get. This is an area of supply. So we'll expect that if the market pops back, like if it comes back, we'll expect to sell, but now supply fails. So now we can see that this area here, you get, becomes what we call a pivot. And now in this pivot, there could be many. We can target a fair value gap, for instance, and it's going to be one of the key things. Now, uh, when we have something like this, like a fair value gap, it's one of the signs of high momentum. Now here in this zone, we can get in and then we start to buy. But overall, we can say that if at all, when we take profit, like you should be keen, we moved and then we return because we have a liquidity point here, you get. We have a liquidity point over there. But then uh, when we came, this overall, this zone here had become a demand zone, you get. Not until maybe if we broke it. But now when we get a reversal, let me not overgo in details. When we get a reversal, and then this zone here has become now demand, we could be looking for buys there, you get. Now range created supply, we are looking at the case of bullish, at the bullish scenario, you get. Now range created, we've seen the pivot created, and now range created. We can see that here in this one the market moved fairly sideways. Now when we move sideways, we are bullish. When we move sideways, I told you, we can consider we have this minor consolidation that we're seeing over here, you get. This we are going sideways, you get. We are going sideways. And now overall we can see that these price points, we were moving sideways, you get. We can aggregate it in this zone here, like the market was going sideways, you get. It was going sideways. Now we can see that sometimes we wait. Okay, it is ranging because this is a trap, you get. This is a trap. If at all we come and then let's say we reach this area, and then we had determined it to be an area of supply, for instance, you get. If at all we had determined it to be an area of supply, now for us we sell here. If at all we fail to break down, you get, So we create some kind of a range, you get. So now, if at all that happens, you get, sometimes we wait. Now they aggressively broke out, you get. So we got a break of structure, you get. So we have our range over there, but then overall we can see that we got a break of market structure here and a bullish one, you get. So when we got a break of market structure over there, you get, we can see that the market retraced back. And then what do we see here? We see what we call, one of the strongest things that we see is what we call a fair value gap, but it was overlapping with uh, it was a fair value gap. It's a fair value gap overlapping with an order block. You get a breaker order block. So this is a strong confirmation. So you would get in here. You get either aggressively, and I've talked about aggressive entries, or you can either enter passively by setting a buy limit over there. You get. So now, not to make this long, let me go to a case for bearish scenario. You get. So now we have a range overall. You get. We have a range overall just over there. The market is going sideways. You get. The market is going sideways in that kind of, in this zone here. So now, what are we interested in? This is what we are interested in. We are interested in determining. We having, first of all, we having this area. You get, or this zone. Actually, let me just mark this one. We having our area of supply. You get, we having our area of supply over there. You get, and now we are having our area of demand. You get, our area of demand. So our demand is just over there. You get? So now when we see that supply and then demand down now, what comes next? We can see that supply was hit like three times. You get, the market would reach here and then it is respected. It sells. You get, so we don't know, even the market was reaching these areas of demand and then it would buy. Actually, if I'm to properly show, so we can see that the market fairly, it was going sideways in this area here. You get, we are going sideways. You get, so we wait for to see where the market really wants to go. So we can see that we got a break of structure. So we broke demand there. You get, we got a break of structure. You get. So now when we got a break of structure, sometimes now we start targeting different things. One of them could be a fair value gap, another block. We shall be seeing all that. So I'm not looking so much at entry types, but then I talked about how to enter and exit. You get. So I'm trying to really show you how to enter. You get. So we got a break of market structure because I told you it takes a lot of money to break these zones here. You get. So now we pop back. You get, and I told you there are different reasons as to why we return back. You get. So this was our fair value gap. You get. So now, as we return back, one of the reasons as to why we return, there could be unmitigated orders or people who are selling now because we've broken out. You get, people who are selling now, they come, their stop losses are just there, they hit you, and now they proceed. I believe that has happened where you determine market direction, and then your stop loss is hit first, and then it proceeds. So now, I believe right now you've tried to understand, you've gotten a glimpse about supply and demand, institutional supply and demand. And now there's more to talk about. I just request you guys to stick around. More of this is talked about in mentorship. And uh, if at all you're interested, you can check out the description, or you can also text me on Telegram. The link is going to be the description. For now, I appreciate you guys for watching, and just wait for more.